Thank you, Mr. Chairman, Mr. Ranking Member, and thanks to the panel members for being here today. And I'm a simple soldier, and I appreciate your son serving in the Air Force, and I appreciate your service in Vietnam, where my older brother served. And to me, this seems like another example of we have to pass the bill to know what's in it, because now we're all of a sudden seeing again that the unintended circumstances, and I think that this once again represents a rule, a regulation, whatever you call it, that is counterproductive to what established this country and made it great, and that's the free market and free enterprise system. I mean, just the same with Dodd-Frank. We're finding out with Dodd-Frank we have more problems with our small community banks and their relationship with our small business owners. And the same thing with this here now. With the Patient Protection Affordable Care Act, we find another provision that is causing more problems for our small business owners. So my initial question is to Mr. West, Mr. Livingood, and Ms. Turner, is what do you see as the most detrimental effect of this new MLR rule, regulation, whatever you call it, within your respective lane?
I'll go first. I'm aware that it has become caused an impact upon my agent's revenue stream and his ability to possibly attend to my needs as deeply as he did in the past, because I rely upon my agent heavily. I have implicit confidence in his ability to perform. When I have issues that arise, and that's not often, but when I have issues that arrive, I pick up the phone and say, Paul, you have a problem. And I tell him what the problem is. And then I hang up the phone, and I know that that problem is going to get resolved expediently and to the best benefit that possibly that could occur to me. So as I see him being concerned about, do I want to still stay in this market, or do I want to do something, that causes me great concern. Because if he weren't performing, same as my CPA, my attorney, et cetera, if they weren't performing, I have immense leverage. I can terminate the services. If we're dealing with some other entity, such as an insurance exchange, I think I've lost that leverage. But that's my observation of the most immediate impact.
Mr. West, I think that the biggest problem is just this Washington knows best attitude. I mean, states are the regulators for health insurance, and they can solve problems when a company may go against some regulation about whether or not skiing is included. That's not a federal government problem. And yet states have had to go through amazing paperwork burdens, regulatory to work to create petitions to Washington to exclude them from the medical loss ratio rule or to give them some relief. And HHS, in its wisdom, has told states like Indiana, I'm sorry, we know best, not you. And Mitch Daniels, governor of Indiana, said that denying Indiana the waiver from the MLR rule is going to lead to higher costs, and it's working against personal freedom. And he says, for example, that in Indiana, they have a disproportionately high number of people with health savings accounts. And therefore, because, again, of this obscure provision in the rule, it's particularly difficult for HSAs to meet that test, even though it's affording businesses and the state more affordable coverage. And to Dr. Jost's comment earlier, a number of companies have said we are leaving not just because of the MLR, but because of this burden of regulation of which the MLR is a part. The American Enterprise Group announced in just this October that it's leaving the market in 20 states. The MLR is a big contributor. Aetna is leaving the market in many states, including Colorado, because it's saying that it can't meet the test in the individual and small group market. So you're losing the exact competition that you're talking about because states are asking Washington for relief from the MLR rule, and Washington is telling them, no, we know better than you do what's right for your health insurance markets. I think it's that arrogance that is really the root of the problem.
Congressman, I would use the case of World Insurance in Colorado as a perfect case study. World Insurance was a relatively small insurer that entered the state. They were very creative with their policy definitions, and offered an extremely high value product. And that product was based on two premises. One, giving the consumer the ability to tailor their coverage to their needs. The fact that they defined skiing as a high-risk activity was not evil. It was not illegal. It was simply part of their product offering. Very interestingly enough, they also entered into a partnership with agents, and they offered a higher than average commission rate to agents with the understanding that we as agents would represent the company in a way into properly delivering that product to consumers. While there are a lot of skiers in Colorado, 95% of the residents in Colorado do not ski, and they enjoyed the opportunity to knowingly select a plan that wouldn't cover skiing injuries at a substantial premium discount. The direct result of the MLR calculation and many of the other factors inherent in the legislation was to deem those sorts of practices to be somehow wrong, and World Insurance has left the market space. I can tell you for a 2-year period, the World Insurance product was the one that I owned and that I recommended for the vast majority of my clients based on lowest premiums and best value delivery to those consumers under the appropriate circumstances. The moment that I learned from a client or we discussed the issue and he told me I'm a skier, I would immediately say, well, then we need to move to another product. Those choices have been all but eliminated from the marketplace now. And the results of the legislation is decreased competition. This company has left the space. Their highly effective, cost-effective premiums are no longer available to my clients. And I would tell you, as a former customer of theirs, there was nothing wrong with the product they delivered.
Thank you. Can I continue on, Mr. Chairman? And Mr. Ranking Member, if that's Professor Yost, I have a letter here you recently signed on to members of Congress about the medical loss ratio. And the letter states in part that the NAIC unambiguously concluded that a year ago producers' commissions are an administrative cost. And you participated in the NAIC's fall 2010 meeting. As a matter of fact, I'll read the statement out of the letter that as the NAIC itself concluded a year ago, after extensive deliberations, producers' commissions are an unambiguous administrative cost. But at that 2010 meeting, fall 2010 meeting, the NAIC took no action on these brokers' commissions. And in fact, since the January 2010, they've been urging Congress and the HHS to accommodate brokers' commissions in the medical loss ratio. And I want to read from that NAIC report where it says, in a recent letter to HHS Secretary Kathleen Sebelius, the NAIC reiterated the important role of insurance agents and brokers. Director Hudson stated that the NAIC encouraged Secretary Sebelius to recognize the essential role of insurance agents and brokers and to accommodate compensation arrangements in any MLR regulation that is promulgated. Director Hudson made a motion, seconded by Commissioner Savegny, for the NAIC to appoint an executive committee level subgroup to work with HHS to accommodate agent and broker compensation in the MLR, particularly during the transition to 2014, and the motion passed. So my question is, why would you sign on to a letter that actually contradicts what happened at this NAIC meeting?
Thank you for an opportunity to comment on the NAIC's involvement in this issue, because it's a complicated story, but I'll try to keep it brief. The NAIC's task under the statute was to come up with definitions, establish definitions and methodologies for implementing the statute. The statute does not permit either HHS or the NAIC to remove agents and brokers' commissions from the denominator because it's not there. It allows taxes, regulatory fees, various other kinds of adjustments, not agents and brokers' commissions. So the NAIC recognized that when it unanimously adopted the recommendation, I believe it was unanimous, on the NAIC rule last year. However, the NAIC is concerned about brokers and agents for the same reason we all are. They do provide valuable services to insured consumers. So they said, if there's anything HHS can think of to do here that we didn't, please do it. HHS couldn't think of anything to do that they couldn't because it read the statute exactly the same way that they did. There's no other way to read the statute, really. So the NAIC appointed this task force, executive level task force, to look further into the question because it was a question of great importance to them. The task force in turn asked the B committee, the Health and Managed Care Committee, to look into it, and they asked the Health Actuarial Task Force to look into it. And they wrote a very comprehensive report, which I would really urge all of you to read. What that report found was—
But let me just for 1 minute.
Okay.
But when I read this letter, this letter makes me believe that the NAIC is supporting keeping this unambiguous rule, this MLR, as it is. That's what this letter says to me.
That letter is from, I believe that letter is from consumer representatives to the NAIC. We do not speak for the NAIC. We speak for consumers to the NAIC. Let me just finish.
Well, but why, I mean, so you're agreeing with something that obviously it seems that the NAIC did not say?
The NAIC said in its initial finding that there is that the current law does not accommodate them. Anyway, there was this task force. I'll make this quick. This task force report found, number one, that although some places agents' commissions were being cut, other places there weren't, and number two, that in states that already had MLR rules, like the federal rule, consumers were not having a hard time finding agents and brokers. But it did come up with, I believe, 9 or 12 alternatives for Congress to consider changing the law if they wanted to reinstate agents and brokers' commissions. That then has been a subject of debate within the NAIC since that time, and just about 2 weeks ago, well, November 22nd, the NAIC plenary, all of the state insurance commissioners voted 26-20 with 5 abstentions, a very close vote for the NAIC, which usually operates by consensus and frankly a political vote, voted to recommend to Congress that something be done for agents and brokers, and that's basically what it says. So it's in your lap, but I would strongly urge you, for the sake of small businesses, don't drive insurance premiums up when they're just coming down right now.
Everything shows that insurance premiums are going up. I mean, even in my simple little Southern, understanding of math, it seems that they're going up, especially since January of 2009. Thank you, Mr. Chairman. I yield back.